Okay. All right. So let's see. 2, 4, 6, 8, 10, 11, 12, 13, 14. So we have a couple of people missing still. So I'll just, I guess, take attendance in a couple of minutes because see if anybody else is going to join us. It's time to start the class, but we'll give them a few more minutes. All right, so where we are right now is we've pretty much finished the balance sheet. Let me just get to my textbook here. My online version so that I can work with you. Okay, here we go. So we finished with the balance sheet, and one of the things that I had mentioned a little bit earlier in the, I'm going to bring this a little closer to me. All right. What does that do to my picture? Oh, not bad. Okay. I had mentioned that in the 70s or the 80s, because of the fact that we had inflation that was running a little more rampant, and this is in the book, it says, in October 1979, the Financial Accounting Standards Board, FASB for you accountants out there, issued a ruling that required large companies to disclose inflation-based accounting data in their annual report. This information was to be disclosed in addition to the traditional historic cost data and could show up in the footnotes or in a separate full-fledged financial section with detailed explanations. However, with the decline in the inflation rate to historic low levels, the standard is no longer in force, and the inclusion of inflation-adjusted data is no longer required in any form. If a company wishes to adjust its balance sheet or income statement data for inflation, it is purely a voluntary act. Now, the question becomes, what is the future going to hold for us? I think we're sitting looking at inflation for the last year being at around 7%, which is the highest it's been in decades. If we're going to continue in an inflation-fueled economy, is that going to reinvigorate this particular FASB ruling? So I don't know. The future will tell. All right, what I really want to do is today is I want to try and complete this chapter. And really the thing that's left is the statement of cash flows. And this is the third of the major statements that are sort of required, if you will, from the accounting department. We need our income statement. We need our balance sheet. We certainly can take a look at a statement of reconciliation of retained earnings, but a statement of cash flows is actually quite important to a business. I remember when I was in school, I thought to myself, oh my God, another statement, what in the world do we need this for? But the reality of it is that you really do need to be able to tell if you're going to have cash. So your statement of cash flows is going to give you an idea as to whether or not you're going to be able to pay your bills. And once again, when I was in school, I didn't understand that being profitable, just having a positive net income, was not necessarily going to guarantee us cash. Just because of the way that things occur in the business world, you may have used up the cash on things, but are still, positive on your net income, which is a great thing. You can't stay in business for an extended period of time if you're constantly losing money. So you have to show some profit occasionally, but the cash flow statement is something that we're going to use to run our business more of a day-to-day type basis. The purpose of the cash flow statement is to emphasize the critical nature of cash flow to the operation of the firm. According to accountants, cash flow represents cash or cash equivalent items that can easily be converted into cash within 90 days, such as a money market fund. The other thing that we have to take into account is that the other two major statements that we've already talked about, the income statement and the balance sheet, these are done on an accrual basis. See, one of the other things that we could do if we really wanted to talk about it is we could talk about accounting methods. Okay, and what you guys learn, when you take your accounting courses here in college, is that most everybody wants to use the accrual basis of accounting, and that's pretty much the standard. You have to use the accrual basis if you're above a certain size. You have to use the accrual basis if you're going to be publicly traded. You have to use the accrual basis, for a lot of different reasons. The accrual basis for accounting is considered to be the best way of stating your business situation because of the fact that it tries to match up in time the various revenues and expenses that are involved in running the business. Okay, so if I have a sale to one of my customers, in the business world, it's probably being sold on credit, trade credit. I'll give my customer 30 days to pay me. So I have a sale, but the actual cash transaction takes place 30 days from now. So I have, in essence, a legal transaction which shows me making revenue on the accrual basis, but on the cash basis, that's really not going to happen for 30 more days. On the other side, if you look at your expenses, you're going to have purchased your raw materials, or whatever types of expenses that you have out there, and they're going to be in a different time frame also. So if I buy my major raw materials for the product that I manufacture, I buy it and I buy it on credit. Okay, I have trade credit with my suppliers, with my vendors. So I have received my 100 tons of steel for the next run of my widgets, and I don't have to pay for that for 30 days. But here's the transaction. I've purchased the steel. I have it available to me, and I owe money for it. So under the accrual basis, we want to put that into the time frame where it actually occurred. The same with the sale. So the accrual basis matches things up so that we can take a look at our transactions and we can say, well, these are the things that are happening, and this is, we're making money or we're losing money, but it's based on this accrual theory, and it's moving transactions into periods that don't have anything to do with cash. Okay, if you were a cash basis taxpayer, then you wouldn't record those transactions until the cash effect of that transaction occurred. So let's say January 15th, I sell $100,000 worth of widgets to one of my customers with the understanding that they have 30 days to pay me. So I have $100,000 worth of sales in January that I get paid for in February. If I'm a cash basis taxpayer, I'm not going to actually record or recognize that $100,000 in revenue until I receive the cash in February. Once again, it's changing when things are being recorded. Accrual basis, we would record that in January. Cash basis, we would record that in February. Same thing with the purchase of my raw materials. If I had to buy the raw materials 30 days in advance of when I would expect to make the sale, let's say that there's a 30-day cycle for my inventory to go from raw materials to finished product to sold, then what would happen is the steel that I had to buy to make the widgets that I sold in January, I bought in December. So under accrual basis, I would have a purchase of my raw materials. Very likely that would go on to inventory. So it would be a transaction that would go into my asset account. but it would be recorded in December. It would not be recorded in January when I actually pay for the inventory. Okay, so as you see, we've got transactions that are running from December for things that are happening in January that can also be recorded in February. So the cash basis is not preferred for the accounting profession or the finance profession. But what we have to do is we have to understand that cash flow is an important part of running our business. So therefore, what we need to do is we need to create that third statement, which is the cash flow statement. Now, there's two ways of doing this. One way of doing this, let's see, am I on the right page here? Go to the next page. So when I read through here earlier, there's two ways of doing this. One would be to go back through and take all of our transactions and convert them. This is called the direct method. What we would do is we would convert every transaction to a cash basis transaction, keeping a separate set of books. And just keeping our statements based on a cash basis accounting. That would be difficult to do. Most people don't want to do that. So we use the indirect method, and the indirect method is, here we go. The indirect method is we use net income as the starting point, and then we make adjustments to convert from the net income to the cash flows from operations. Okay, so what we're going to do is, and almost everybody uses the indirect method. Very few people want to actually keep a whole second set of books. So what we're going to do is we're going to use the indirect method and convert the current statements that we'll have, the income statement and the balance sheet, into a cash flow system. Okay, now there's three steps. If you're keeping along with me in your textbook, there are three steps to developing the cash flow statement. We have the first step, which is to determine cash flows from the operation activities of the business. Number two is to determine the cash flows from the investing activities of the business. And the third part is to determine cash flows from the financing activities of the business. Once we've done all three steps, we put that together into one form, which is going to be our cash flow statement, and we'll be able to tell what the overall cash flow for the business was. But by breaking it up into those three different categories, we can see where the cash flow or the cash outflows are occurring in the operation of our business. Okay. Since I've given everybody enough time to get in here now, I think I do want to do attendance real quick just to get that out of the way. So let's do that. Emily Baker, you here?
Here.
Okay, Matt Castle, I did see that you had checked in. Yep. Peyton Ennis?
I'm here.
Okay. Evan Gerber?
I'm here.
All right. Travis Harvey?
Here.
Okay. Seon Huang?
Here.
All right. Salam, I think I saw you check in. I know you have trouble with your microphone all the time. Haruta Kuroda?
Here.
All right. Connor Lovick?
Here.
Destiny Merriweather? Destiny? No. Jeremy Meyer? Thought I saw Jeremy.
Here.
There you
Yep.
are. Okay. Haley Phillips?
Here.
Okay. John Retton?
Here.
Owen, you out there?
Hello.
Hi, Owen. And Lucas?
I'm here.
All right, great. All right, that being out of the way, let's move on and talk about the cash flow statement. I'll start using the giving you the sharing of what I'm looking at in the book. So that so let me do this real quick. Go to share screen. Right. Okay, share. All right, so what we're looking at right now is basically the cash flow chart for our company. Cash flows, So if we take a look at the boxes, cash flows from operating activities, and then we move to cash flows from operating or investing activities. Then we move to cash flow from financing activities, add 1, 2, and 3 together to arrive at the overall cash flow. But what is it? Cash inflows are the generation of funds in normal operations. Cash outflows are expenditures of funds in normal operations. So there's your operating. Under investing, we have sale of plant and equipment or liquidation of long-term investments is where our cash inflows are. And the cash outflows in investing would be purchase of plant and equipment or long-term investments. And cash flows from financing would be sale of bonds, common stock, preferred stock, and other securities. And the outflows would be the retirement or repurchase of bonds, common stock, preferred stock, other securities, or payment of cash dividends. Okay, so that's basically what we're going to see there. So let's start talking about steps in computing net cash flow from operating activities. Let me see if I can get that all on one page. No, we'll have to slide it. All right, so we start at net income. And then if you can see, we have a plus sign there. We're going to have net income. Then we're going to add back in depreciation. Now I'll stop and we'll talk about that for a second right now. So going back to when we looked at the income statement that we were created, and we're going to continue using the information for that Kramer Corporation that we did the income statement and the balance sheet for. So we're going to have the net income from Kramer Corp, which I believe at the end of it, we ended up with $100,000 worth of income. So our net income is there. We add back in depreciation. Why do we add back in depreciation? Because there's a little plus sign there. We add back in depreciation when we're talking about cash flow. Who wants to hazard a guess as to why we add back depreciation? Well, the answer is because depreciation, although it's an expense and we're allowed to take it on the income statement as an expense, it didn't cost us anything in the current period. Yes, I know that when we purchased the assets, we did have to have some sort of outlay of cash in order to buy, say we're talking about $100,000 piece of equipment that I use in the manufacturing of my product. At some point in the past, it did cost me $100,000 in cash, but in this particular accounting period, let's say we had $10,000 worth of depreciation on that piece of equipment. We get the expense. So on our income statement, we have whatever our revenues are, and one of the expenses that we deduct is depreciation. Okay, depreciation gets added back in because it was not cash based. It was an expense that we were allowed to take on our income statement to reduce our income, but it didn't cost us any cash. We spent the cash, I don't know how many periods ago. The expense is here because, you know, what's the whole thought behind depreciation? Depreciation is all about the accountants trying to, once again, to put the expense in the same time frame as the revenue that it's created. So if I have a piece of machinery that costs me $100,000, it has a 10-year life. I'm just going to use straight line depreciation to make this simple. I'm going to have the initial outlay of the $100,000 for the piece of equipment. And each year for the next 10 years, I'm going to use up 1/10 of the value of that machine. And I get to put it against the income in the period where I used up that portion of the machine. That became that much more obsolete or worn out or whatever. But it's an accounting effort to put an expense in the period where we had the income. Okay, so we put the expense into this income statement, but we did not pay any cash. So since we're talking about cash flow, we add it back into income. All right, then what we're going to do is we're going to go to the balance sheet, and we're going to look at differences between the beginning balance sheet for the period and the ending balance sheet for the period. And we're going to look at current assets first, okay? So we have minus here, minus increases in current assets. Or we have plus decreases in current assets. This is an either or. This is not both. Okay, so if you look at the total current assets for the beginning on the balance sheet at the beginning of the period, and then look at the current assets at the end of the accounting period, you're going to have either an increase or a decrease. You know, oh yeah, ultimately the individual accounts may change. And I guess, I guess we could look at it as individual accounts. So I guess let's leave it that way. If we have an increase in current assets, we subtract that number. Now, this sounds kind of counterintuitive because you start, at least when I was doing accounting or when I was in school learning accounting, I was always looking for some sort of a shortcut to make it easier for me to understand what I was looking at. And so I always looked at, oh, an asset. We're going to increase an asset. So if all of a sudden I went from $100,000 in accounts receivable to $150,000 in accounts receivable, I had more assets. That's a good thing. I should feel good about the fact that my company is getting stronger. I have more assets. Okay, maybe we'll talk about whether that's a good thing or a bad thing later on. But in order to get that increase in my asset, I had to fund it somehow. So an increase in assets means I have a decrease in cash. These are things you're just going to have to memorize. Or if you want to, if you want to picture the balance sheet, and you want to picture a T account as to how the journal entry would be, all things remaining equal, if I have a debit to accounts receivable, a current asset, if I'm dealing with cash, there has to be a corresponding credit to cash, which is a reduction in cash. Okay, accounts receivable goes up. I had to fund that somehow. The only thing that we're worried about right now is cash. So that means an increase in a current asset is a decrease in cash. So on our spreadsheet here, or on our flow chart, we start with net income, add back in depreciation because it's not a cash event. And then if we have an increase in current assets, it's a use of cash. So we would subtract it. What if I had a decrease in current assets? Okay, so let's say that accounts receivable goes down. At the beginning of the period, I had $100,000 in accounts receivable. At the end of the accounting period, I only had $50,000 in accounts receivable. Well, what happened? I had to have collected those accounts receivable, right? So what am I doing? What's my big purpose here? I have to turn everything into cash. So when I decreased that asset, I turned that asset into cash. So a decrease in a current asset is an increase in cash flow. Okay, like I said, it seems kind of counterintuitive. It seems backwards to me, but this is the way it is. You'll have to think it through, memorize it, or come up with some sort of a way that you feel comfortable with it. Continuing down our flow chart, an increase in current liabilities. Okay, pick a current liability, accounts payable. An increase in accounts payable. So I start the period with $100,000 in accounts payable, and I end the period with $125,000 in accounts payable. Okay. Intuitively inside my head, I go, oh, that's bad. I owe more people more money. That's a liability. It makes my company look less strong. Okay, perhaps. But what happened to cash? Well, I'm using other people's money. Instead of only owing $100,000 to other people, I now owe $125,000. I have an additional $25,000 of somebody else's cash. So an increase in a current liability will be an increase in cash. Okay, conversely, a decrease in current liabilities. If I have a decrease in accounts payable, I started with $100,000 in accounts payable. At the end of the period, I only had $75,000 in accounts payable. My theory, oh, that's good. I owe less money. I have fewer liabilities. I'm a stronger company. Yeah, perhaps. But if I started owing my vendors $100,000, and at the end of the period, I only owe them $75,000, how did that happen? Well, I had to pay them. I paid them an additional $25,000. So that is a use of cash. Okay, so a decrease in a current liability would give me a reduction in cash. Okay, once you take all of those transactions into account, start with the income on the income statement, add back in depreciation, and then look at what happened to current assets and liabilities and adjust the cash flow based on what happened. Okay, that's going to give us our net cash flow from operations or operating activities according to the book. Okay, and if you look at the next page in the text, it's just a narrative of what we just talked about. Okay, we'll get to that. Look at the actual numbers on a chart on the next couple pages. Investing activities, cash flows from investing activities is the second section. It relates to long-term investments and other issues, plant and equipment, investing in long-term uses. So what does it say here? Increasing investments represents a use of funds. Decreasing investments represents a source of funds. Okay, so once again, if I have plant and equipment of $1 million at the beginning of the period, and then I have a plant and equipment of $1,100,000 at the end of the accounting period. So I've increased my long-term assets. This is in the investing activities category. I've invested in $100,000 in new equipment. Once again, assets have gone up. Yay, that's great. But what did it do to cash flow? Cash flow has gone down because I had to pay for that additional asset with money. Okay, so if my investments go up, if I go from $1 million to $1,100,000 in plant and equipment, that is a use of funds of $100,000. If I reduce my assets, I end up selling one of my pieces of equipment. So I start the period with $1 million in assets, end the period with $1,100,000 in assets. No, excuse me, change that. Start with $1 million, end up with 900,000. That reduces my assets. By reducing my assets, that means I turned it into cash. That is an increase in cash flow. Okay, so once again, you have to pay attention to that. Financing activities. This is basically going to be down in the owner's equity section. In reality, financing activities apply to the sale or retirement of bonds, common stock, preferred stock, and other corporate securities. Also, the payment of cash dividends is considered a financing activity. So let's look at that. If we buy back some of our common stock. So we had $1 million in common stock at the beginning of the period. At the end of the period, we have $900,000 in common stock. Well, let's see. Would that be a reduction or an increase? Okay, so sale of forms security. Okay, yeah. So if I increased my common stock, went from $1 million to $1.1 million, I increased my common stock. That obviously the answer is I raised cash. I raised capital by selling that additional stock. So that would be an increase in cash. If I were to buy back some stock and reduce the amount of stock that was outstanding, then that would be a use of cash. So that would be a subtract cash for this particular section. Okay, and it makes perfect sense when we're talking about the payment of dividends, because we're really, like I said, looking at the owner's equity section of the balance sheet here. So if we take cash and pay it out to our shareholders in the form of dividends, that's going to reduce our retained earnings, which is part of the financing of the company. So if we reduce one of the accounts that's out there in retained earnings, that would be a use of cash. If retained earnings has gone up, then that's going to be a source of cash, but that's going to be on the income side of things. So payment of dividends obviously is a use of cash. All right, now, assuming you guys can see this, maybe I can make this a little bit bigger. Okay. All right, so here's Kramer Corporation. And this is the comparative balance sheet. Now, we would have seen the balance sheet, I believe, for year ending 2010. We had not seen the year ending 2009 at the beginning of this process. So let's take a look at the asset side of Kramer Corporation. We see cash starts at 30,000, ends at 40,000. Marketable securities is unchanged. Accounts receivable, when I say net, that means we've already taken our expense for uncollectible receivables. So receivables have gone from 170,000 to 200,000. Yay, an increase in the asset. Yeah. What did it do to cash? Well, it reduced cash, right? Inventory went from 160,000 to 180,000. Prepaid expenses went from 30,000 to 20,000. Okay. So if we had prepaid expenses of $30,000 at the beginning, and at the end we had $20,000, we reduced an asset. So what is that going to do? That's going to give us cash. Yeah, because we don't have as much money tied up in it. So that's a positive number. Okay, total current assets. We started at 400,000. We ended at $450,000. So a change of $50,000. It increased. So an increase in assets is going to be a decrease in cash. So I'll bet you right now that when we get done with all of this and we look at the statement of cash flow, let's do it. Can I do it? I can't do it without shrinking the screen. We'll come back to that. All right. So now let's go down to investments long term. We've got some sort of an investment that we started with 20,000 and we ended with $50,000, an increase in an asset, which makes us look better on our balance sheet, right? But what did it do to cash? It cost us cash to go from 20 to 50. Plant and equipment. We started at $1 million. We ended at $1.1 million. That's going to be once again, it's an increase in an asset. It looks great, but it cost us cash. This is not going to be operations anymore. This is going to be in investments, right? So change in long-term investments and change in plant equipment. That's going to be in the investment, the second section of the cash flow statement. Accumulated depreciation went from 550,000 to 600,000. So that means we took $50,000 in depreciation expense during the year, right? So what's going to happen is we're going to have to, we're not going to deal with this right here because it's going to be, it was dealt with on the income statement. So that $50,000 expense shows on the income statement. So that's going to be the first thing we add back is the depreciation, right? We'll see that. Net plant and equipment went from 450 to 500. So we're going to see that that's going to have cost us $50,000 also. So overall total assets went from 870 to $1 million. Okay, we look good, but it's going to have cost us cash to make that happen. All right, on the liability side, accounts payable went from 45,000 to 80,000. And once again, the amateur finance person is going to say, hey, that's great. We've got, no, it's going to say, oh, that's terrible. We owe more money. But you know what? Now the trained finance person says, oh, we're using other people's money. That's great. So for us to go from $45,000 in debt to $80,000 in debt, that's an increase in cash. Okay, notes payable didn't change, so that doesn't change anything for us. Accrued expenses went from 35 to 30, so that is going to be a reduction in a liability, which Hey, it looks good on the balance sheet. But no, cash flow wise, that cost us $5,000 to make that happen. Long-term liabilities, okay? So bonds payable. I think this is going to end up, we'll see on the next page, because it's a bond payable, very likely this is going to be not under investments, but under the financing side, the third section of the balance sheet or the cash flow statement. We went from $40,000 in bonds payable to $90,000 in bonds payable. So an increase in a liability gives us an increase in cash. Okay, moving down, shareholders' equity, preferred stock, that didn't change. Common stock, that didn't change. Capital paid in excess of par, that didn't change. Retained earnings, we had a change there, but we know some of that is from net income. Some of that is from dividend payments. We'll come back to that later. Total stockholders equity, 650 and 700. It's just making sure that our total liabilities and shareholders equity, excuse me, this is going to balance. The $1 million down here has to balance with that $1 million there. The 870 has to match that 870. All right, so here is our cash flow from operating activities. All right, so net income, earnings after taxes. Okay, so that was EAT. Now, I guess I don't want to bother going back to try and find where that is. But if you have the ability to flip back in your textbook, go ahead and do so. And you'll see that for Kramer Corporation on table 2-1, we showed net income for the company at being $110,500. That was earnings after taxes. So adjustments after EAT. Adjustments that determine cash flows from operating activities. Add back in depreciation. Once again, from table 2-1, we would have taken a $50,000 depreciation expense. We're going to add that back in, okay? Remember, because that was a non-cash transaction or a non-cash journal entry. Increase in accounts receivable from table 2-6. Our accounts receivable is right here. We went from 170,000 to 200,000. So an increase in an asset is a reduction in cash. So negative $30,000 on our cash flow statement. An increase in inventory. So we went from, what was it, $160 to $180,000 in inventory. So that's a $20,000 use of cash. We increased an asset, so it's a reduction in cash. Prepaid expenses. We had a decrease in prepaid expenses. That's an asset. So a reduction in an asset is positive cash flow. So we have a positive $10,000 effect from that decrease in prepaid expenses. Increase in accounts payable. So now we're on the liability side. We had the accounts payable go from $45,000 to $80,000. So we increased that current liability by $35,000. That means we're using other people's money. So that's a positive change in the cash flow. A decrease in accrued expenses, which is right here. Accrued went from 35 to 30. So a decrease in a liability means we had to use cash to make that liability go down. That is a use of cash. Total adjustments for all of our adjustments for operational activities. If you net this out, you come up with a positive $40,000. So we're going to have net cash flows from operating activities of $150,500. Okay, shrink it back down so I can get to the next page. All right, now here what we're going to have is we're going to show the investment activities. Okay, so increase in investments, long-term securities. Okay, we did see that we had increased this particular asset, right? That was a long-term asset, long-term securities. They went up by $30,000. For us to increase an asset, we had to use cash to make that happen. So that's a reduction in cash, $30,000. An increase in plant and equipment. Remember, we went from $1 million to $1,100,000. So that's $100,000, an increase in a long-term asset, which means that we have a reduction in cash of $100,000. So now our net cash flows from investing activities is a reduction of $130,000. All right, now financing activities. Remember, I said that although the bonds were not part of owner's equity, they were a long-term liability. We had increased the amount of bonds that we had out there, bonds payable, by $50,000. Now, since we have other people's money, we have that $50,000. That's an increase in cash. So an increase in a liability is an increase in cash. Then, if you remember from the table 2.1, which was the original income statement, we had preferred dividends that we had to pay out. So we paid out $10,500 to our preferred shareholders, which is a reduction in cash. That's pretty simple, right? We had to pay out cash because that's what the preferred shareholders want, is cash. Then we had to pay out the common stock. We paid them some dividends, and if you recall, that was the reconciliation of retained earnings, where we saw that we had paid out $50,000 in dividends to our common shareholders. So if we net all this out, we see that our cash flow from financing activities is a negative $10,500. All right, here's what we end up with then. We put everything together. Okay, you can see right here through this $150,500, this was the cash flows from operating activities, starting with net income, adding back in depreciation, and then making the adjustments for pretty much our current assets. We increased by 40,000, giving us 150,500. Cash flow from investing activities. So by buying another long-term security and buying additional assets, we used up $130,000 worth of our cash flow. So that's going to be a negative number, negative 130,000. Cash flow from financing activities, we increased the bonds, but we paid out dividends to the preferred and common shareholders. So we have a negative $10,500 in cash flows from financing activities. We combine everything together. So we got to the 150 minus the 130 minus the 10,500. Our net increase in cash flows was $10,000 for this particular year. Now, at the beginning, when we did our income statement and we saw that we had that $110,500 in earnings after taxes, net income, if you will, we were feeling pretty good about ourselves. Hey, that was a pretty successful year. We're pretty glad. We're happy that we made that $110,500. Maybe we should all just go out and buy expensive sports cars now to reward ourselves for a year well done. Well, that sports car is not going to be worth, you can't spend a whole lot of money on that sports car, because in reality, your cash flow only went up by $10,000. You consumed that cash through operations, investments, and financing. Okay, so this is where we get into the situation where we have to start worrying about what's going to happen with our cash. Because if you're only looking at the income statement, you thought, wow, this is really great. We had a wonderful year, and you did. You have to have those net incomes that are going to make you happy in order for this company to ultimately prosper. But just looking at the income statement isn't going to give you all of the information that you need to run your business. So at the end of all of these things you did, now you did some wonderful things this year. I'm not saying that it was terrible. You know, you ended up investing in some additional asset out there. You know, theoretically, this is some sort of a government bond or something. You ended up with $100,000 more equipment. you paid money to your shareholders, everybody's happy. There's just not a lot of cash flow left. Okay, so you have to keep in mind that cash flow and net income are often two different things. Oh, by the way, I want to go back and do something. I just want to show you something, assuming that you're able to follow along when I do the changing of pages here. If you go back to your comparative balance sheets for the beginning of the period and the end of the period, look what happened to cash. Started with 30,000, ended with 40,000. What happened with our cash flow statement? We ended up showing that we had an increase in cash flow of $10,000. Well, there it is, right there. There's your check. Cash should change in an equivalent amount to what your cash flow statement says is going to happen. Makes perfect sense, right? All right. Narrative from the book, we see in table 210, the firm created excess funds from operating activities that were utilized heavily in investing activities and somewhat in financing activities. As a result, there is a $10,000 increase in cash balance, and this can also be reconciled with the increase in cash balance, 10,000, moving from 30 to 40,000, as previously indicated on the income statement or the balance sheet. So that's your cash flow. Okay, you see that it's not straightforward necessarily. It's a three-step process: operation, investment, and financing. And it's just looking at different numbers. Okay, so we start with income statement, and then we adjust the income for changes in the balance sheet figures. Okay, now the next thing that we really want to look at in this chapter is the depreciation and what happens with flowing of funds. As I said, and I'm reading from the book now, depreciation represents an attempt to allocate the initial cost of an asset over its useful life. We attempt to match the annual expense of plant and equipment ownership against the revenues that it allows to be produced. So the reality of it is that depreciation, we spent that cash at some other point. If you remember the cash flow statement that we just went through, we had that section which was the cash flow statement for investment activities. So when we bought that piece of equipment in whatever year we purchased that asset that's being depreciated, we used cash in that particular year. That was under the investment portion of the statement of cash flows. So we would have spent out a tremendous amount of cash at that moment in time. It would have affected our cash flow statement at that moment in time. We're whatever number of years down the road, and we're just grabbing that back now. Okay, so we spent it when we bought the asset. Now we're depreciating it because this is what we're supposed to do according to accounting rules. But that depreciation is not using cash, and it allows us to show an increase in cash flow because it's an expense that we don't have to pay for in cash today. All right, the next thing in your book is this concept of free cash flow. Free cash flow, realistically, I'm not going to spend a ton of time on it, but what it ends up being is a situation where we're going to have a certain amount of cash flow from our operations and such. But what we really need to look at is, are some of those cash flows already spoken for? Is there something out there that's going to consume them so that, oh, this isn't the windfall. We've got all this cash flow that we were able to create. Are there automatic requirements on our cash flow? And there are. And the concept here is that in order to get to free cash flow, which is cash flow that doesn't have any responsibility, we have to take out costs that investment people, operations people look at as being absolutely necessary in order to maintain the status of the I broke it. The status of the the company. Okay, so are there going to be continual needs to improve our plant and equipment? We're not going to say, okay, it's day one of our business, we're going to spend $1 million on plant and equipment. We're going to buy land, we're going to buy a building, we're going to build a building, and we're going to buy all the equipment we need to run this business. And we don't need to do anything again for the next 10 years. Is that a realistic vision? I guess you could do it. But what's going to happen is that day that you go into business, you're going to be the most technically evolved, the most efficient company in your industry. And you're going to have theoretically an advantage over your competitors because they're going to be dealing with technology and machines that are becoming obsolete and worn out. Well, what are your competitors going to do? Your competitors don't want to be left in the dust. They don't want to end up being driven out of business because of the fact that you've invested in new technology. So they're going to start doing that. So a year or two after you've started doing business, your competitors are starting to put money into plant and equipment also. And what does that mean? That means that you're no longer the top of the heap. They have better technology, so they're going to have a little bit of an advantage over you in efficiency and things like that. So is it reasonable for you to think that you're going to be able to just sit stagnant for 10 years? No, it's not. You're going to have to increase your investment in your plant and equipment. You're going to have some sort of a cost on a regular basis to make sure that you have at least relatively current technology so that you can compete with your competitors. Okay, so you're going to probably end up budgeting something for plant and equipment every year that you're not going to end up in free cash flow. It's spoken for. Although you have positive cash flow, hey, we had, in that income or that balance statement of cash flows that we just completed, we saw that we had invested $100,000 in equipment that year. I don't know if that's the way that Kramer Corp does it every year. Do they invest $100,000 in equipment every year? Maybe. I don't know. We don't have enough information at this moment. But they felt that they were forced to spend $100,000 in getting new technology, new equipment, either because their stuff was worn out or technology had changed, and they were perceiving a competitive disadvantage. So that's part of it. Now, the other part of this that is going to be money that is not going to be, or cash flow that is not going to be free cash flow, is the money that you have to pay in dividends to your shareholders. Keep in mind, the shareholders gave you their money because they have expectations. They didn't give you their money under the belief that, oh, I never have to see any kind of return on this. I'm just happy to have put that money with a company so that it'll be safe, so that 10 years from now, I'll be able to ask for my money back. If that's your theory, go put your money under a mattress, because you have the same, other than the possibility of it being robbed in the middle of the night by somebody who breaks into your house, you're getting the same effect. You're just holding money and it's not doing anything. Your investors don't believe that. Your investors want to have some sort of a return. And as I've said repeatedly in this course, your investors, the people who bought the common stock, what they are looking for is two things. They are looking for, one, dividends. They're looking for current income on an annual basis, minimum, usually paid out quarterly. And two, they want the company to grow in value so that eventually, when they do want to sell their stock, they're going to end up getting more money for that stock that they just sold. Okay, so cash flow wise, your shareholders believe that some of that cash belongs to them. So that's not free cash flow. So although you may end up with some cash flow, the fact that you have these requirements on it is a big deal. I will at this point share, there's a picture in the book, so I may as well share it with you. Okay, so what you're looking at is comparison of accounting and the cash flows. So we end up with, this is not Kramer, this is just a quick illustration. Earnings before depreciation and taxes, EBT. EBDT, $100,000, depreciation of 100, giving us earnings before taxes of 900, taxes of 300, giving us earnings after taxes of 600. That's where accounting stops. Cash flow continues. Purchase of equipment to negative $500 in cash, positive $100 charge without cash outflow. Depreciation, we got $100 back in depreciation. So our cash flow is $200. Okay, that's year one. Year two, $1,000 in net income, $100 in depreciation, earning before taxes of 900, taxes of 300, another earnings after taxes of 600, depreciation, we get that back, that $100. This year we didn't have any money on purchase of equipment, so we had a cash flow of $700. Okay, so we have $700 minus $500 that we have to pay in order to purchase the machinery or the equipment so we can stay in business. We had $100 that we had to give to our shareholders. So although we had $700 in cash flow, we didn't have free cash flow of 700. We only had free cash flow of $100 because we had to pay out this other money. Okay, so I'm going to end the sharing. And what I want to do next is I want to move into I guess this is the last section of the chapter. And no, I guess it might be two different things left. Income tax considerations. Income tax considerations. Actually, before that, I do want to point out that in your book, there is a finance in action section. It takes up it does take up a whole page. And its subtitle is ethics. And it talks about Bernie Madoff. Now, that's a name that should mean something to you, but now he's starting to fade into history. Can't remember if he's alive or dead at this point. He may have died. But Bernie Madoff was an investment person who was in the New York area. And he was able to convince some very rich people that he could perform magic with their investments, and he could turn investments. He would be able to guarantee returns that were well in excess of what was going on with the market. So, so for example, if the market was able to turn a 5 to 7% profit margin or income during the year, Bernie would be able to do 15 to 20. He was able to just beat the market like nobody's business. Well, the reason he was able to beat the market was because he never invested the money at all. What he was doing, and this is what a Ponzi scheme is he got investors in year one, promised them ungodly returns. And then because of the fact he was promising these returns, additional people would invest in year two. Well, he would take the money from the people that invested in year two to give earnings to the people from year one. It wasn't that he was investing their stuff and this was actual profit from the investing that he was making. No, he was just paying out the principal from the new investors as income to the old investors so that they would have these guaranteed returns. And then year three, he would have more sales of new people investing, and he would take the money from the people in year three to pay off the income that he guaranteed to the people from year two and year one. And this goes on for many, many, many years. And he was, really showing these tremendous returns when nobody else could. Eventually, the Securities and Exchange Commission investigated Mr. Madoff and found that it was indeed a Ponzi scheme and that he never made any money for anybody. He was just continuing to distribute their principal back to them and pretending that it was income. And of course, pocketing a great deal of it for himself. He doesn't do this just because he's trying to create a reputation. He was basically then taking huge fees to create these levels of income that he never created. I bring up Mr. Madoff, let's see, when he was convicted, he was 71 years old and he received a 150-year prison sentence. So he is not expected to ever get out of prison. I bring up Bernie Madoff because he's going to play an interesting role later on when we start talking about present value. So I bring him up just so that we understand that he's there. All right, now taxes and cash flow. This is an interesting concept here. And one of the things that you really want to be able to take into account here is if you are, many people when they're running a business, it's like, don't worry about it, it's deductible. And that's, you know, a wonderful thing. If you can deduct an expenditure from your taxes, yeah, that's wonderful. But the advice that I will give you if you are in business is don't encounter or create an expense just because it's deductible. Try to make sure that the money that you do spend is deductible. So if you have to spend money, try to make sure that it's a deductible transaction so that you can deduct it on your taxes. Don't go and spend money just because it's deductible. See, the way that we look at this in the business world is that the government is subsidizing some of your activity because they're allowing you to deduct certain expenses from your business. And by doing so, you don't encounter the full cost of that expense. Okay. So basically, if I just a real quick summary of this before we start looking at the things in the book itself, if I have $10,000 in interest that I paid, and an interest expense is deductible as long as it's for a business purpose, and so if I have to pay $10,000 in interest, that's going to cost me cash of $10,000. It's also going to be a $10,000 expense on the income statement. Okay, so it will drop my net income by $10,000. And as a result, I had to pay that out in cash. Okay, however, because of the fact that the interest is deductible, it's going to reduce my tax liability by some number. So let's say that my tax rate, my federal tax rate or my overall tax rate is 20%. I pay $10,000 in interest expense. I'm allowed to deduct that $10,000 in interest on my tax return, which will therefore reduce my net income by $10,000, which will reduce my taxes by whatever the tax rate is times that reduction. So if my tax rate is 20%, I pay $10,000 in interest. 10,000 times 20% is $2,000. That means that I have reduced my taxes by $2,000. Okay, so the reality of it is, although I paid out $10,000 in interest expense in cash, I get that $2,000 back from the government as a reduction in my taxes. Okay, so what we can do is we can look at this as being the government subsidizing certain types of activity. So expenses that are considered to be deductible for tax purposes are, if you will, look at it as expenses that the government approves. Yes, you should be having those types of expenses in your business. And if they don't approve of the expense, they don't let you deduct it. So right now, for example, meals and entertainment expense is not considered to be something that the government believes you should be spending money on. So they don't let you deduct it. Now, many companies will continue wining and dining their customers to try and convince them to start spending money with them. But if I spend $10,000 this year on entertainment, for accounting purposes, I have to recognize it, but for tax purposes, I'm not allowed to recognize that $10,000 in expense. It cost me $10,000 in cash, so I'm going to have lost $10,000 because I've spent it, but I'm not going to be able to take a deduction for it. So I won't get any corresponding reduction in tax. So if I spend the $10,000 on interest, which I'm allowed to deduct, it's only going to cost me $8,000 because the government approves that expense. If I spend $10,000 in entertainment expense, the government doesn't approve of that. I get no reduction in tax, so it ends up costing me the whole $10,000. Okay, so there is a difference between a tax deductible expense and a non-deductible expense. Okay, and so you have to look at it as being a when you actually start thinking about what it costs you to do certain things, you need to really take into account the tax effect. Now, one of the things, if you look through the book is a little bit old. As a matter of fact, I got an email from the publishers earlier this week or end of last week, telling me that they are in the process of updating this book. So there'll be a new edition of it that will come out eventually, probably within the next year. And then I have to make a determination as to whether I want to change the required textbook to the new, most recent current version of this, or use the older version, which, what it does is it drives down your textbook costs. But I can only really do that for so many years before it gets to be so outdated that I have to move to the new book. Anyhow, the reason I bring that up is, and I'll share this with you because I think it's worth sharing. Okay, from the textbook, it talks about corporate tax rates. Corporate federal rates have changed 4 times since 1980. Basically, the rate is progressive, meaning lower level of income, such as $50,000 to $100,000, are taxed at lower rates. Higher levels of income are taxed at higher rates, normally in the mid 30% rate. The current top rate is 35%. But keep in mind, you have state taxes that are also involved, which could be bring your rate up to 40% or higher. That's no longer true. That's something that, because of things that have occurred over the past 4 or 5 years, is no longer true. One of the things that happened during the Trump administration when he was president was, at the very beginning, one of his big things was he wanted to make a change in the tax laws. So there was a massive rewrite of the tax code. And one of the biggest changes, the interesting thing is that, there's on the individual side, they increased the amount of the standard deduction, dramatically, but then they took away most of your itemized deductions. So if you were somebody who had gone through your life trying to make sure that you took advantage of the standard or the itemized deductions, you're probably out of luck. So on the individual side, there was not a huge amount of change, when you've got to the end net. But on the business side, there was a massive change. According to the book, and the book is right here, that it was a progressive tax rate schedule. The lower the corporate income, the lower the tax effective tax rate. The higher the corporate income, the higher the tax rate, maxing out at 35%. Well, that's not how it is right now. Right now, the corporate tax rate is 21%. And it's a flat tax, which is a very unusual thing. The federal government usually does not like flat taxes. They like these graduated taxes that start low and go high, because they tend to say, hey, the people who have less income can't afford to pay the higher percentages. But the people who have a much larger income can pay these higher percentages. Well, the current corporate tax rate is 21%, and it is a flat rate. If you have $1 in income and you're a corporation paying corporate taxes, you pay 21 cents in income tax. If you have $100,000 in net income, you're going to pay 21%, or 21,000. Your effective rate is going to be 21%. Doesn't matter if you make $1, $100,000, $100 million, 21%. Massive change in the tax code. Okay. The other thing is, making it a flat rate of 21%, it increased the rate for the people or the corporations that had lower income levels, and decreased the tax rate for the the massive corporations, the big guys that are out there. The reasoning for that, according to the administration, was that we were losing corporate citizens of the United States, because most of the other developed countries out there, and realistically look at Europe as your example, the countries in Europe that if you were a country that was considered to be resident of England or Switzerland or Belgium or whatever, most of the countries in Europe had tax rates of 20 to 25%. So what was happening is the corporations were relocating their home offices to become citizens of these foreign countries, purely to take advantage of these smaller tax rates. The United States was losing tax revenues and losing a certain amount of overall prestige in the fact that the corporations were not located in the United States anymore. I have no idea how successful this particular process was by dropping the tax rate down. Did it draw the corporations back to being citizens of the United States and paying the taxes in the United States instead of the taxes to Great Britain? I don't know. I haven't looked and seen whether the studies have told us it was successful or not. But that's where we are. The tax rate is not as it describes in the book. The tax rate is a flat rate of 21%. And then you do have to add on your state rate from there. And every state, of course, has its own basic rate. So if we were to say that, that the effective tax rate for a corporation is probably around 30%, we probably aren't off too far, because between the 21% at the federal level, and I believe Pennsylvania's rate is pretty close to 10%. So, what are we at, 31%? So if we assumed an effective rate of around 30, we're probably pretty close. So going back to my example of $10,000 in interest expense, that's deductible, and we get $3,000 in tax reduction. That interest really only cost us $7,000, not the full $10,000. All right, so there's a chart here in the textbook which is trying to show that. So if you have a excuse me, if you have a Corporation A and Corporation B, both with earnings before interest and taxes of $400,000. Corporation A has interest of $10,000, bringing earnings before taxes for Corporation A to $300,000. Corporation B stays at $400,000. The tax rate, they're using 40%, $120,000 for Corporation A, $160,000 for Corporation B. So it's $180,000 in earnings after taxes for Corporation A, $240,000 for Corporation B. There's a difference of $60,000. Not $100,000. Why? Because we have this $40,000 reduction in tax right here. That is showing the concept of the government kicking in and helping you with your expenses. Depreciation as a tax shield. Let's take a look at the exact same issue here, but let's say that it's depreciation, not interest expense. So if we had earnings, same thing, Corporation A and B both have $400,000 worth of income. If we have depreciation in Corporation A of $100,000, but Corporation B doesn't have any depreciation, we'll have $300,000 in income in A, $400,000 income in B. Taxes, $120,000 for Corporation A because we have the lower income, $160,000 for Corporation B. Add back in our depreciation to get cash flow, add back in $100,000 for Corporation A, but nothing for Corporation B. We have $280,000 Corporation A and only $240,000 cash flow for Corporation B. So we have a $40,000 increase in cash flow in Corporation A. Why? Because it had this expense that we didn't have to pay for. There was no cash involved. So in this particular example, we end up with positive cash flow. Corporation A ends up with more cash flow than Corporation B because we get the government to kick back $40,000 to us because of that expense that we were allowed to deduct. All right. Boy, timing wise, this came out really well. I'm at the end of the chapter. I'm almost at the end of my time. I do still have 4 minutes. I am going to take advantage of that 4 minutes. I'm going to assign homework to you. Oh, thank you, Professor Gomolchak. I was hoping that we would get some homework in this class. Well, I did not want to disappoint you. Basically, what I want you to do at the end of the chapter 2, under problems, basic problems, I want you to do number 1, number 12, number 13. No, skip 13. So 1, 12, 20, and 21. 12, 20, and 21. So that's 4 problems. Shouldn't be extraordinarily time consuming. You know what? Let's do 28 also. Okay, I will post this on Moodle immediately after class here, noting the problem numbers. So that's 1, 12, 20, 21, and 28. So I'll create a Moodle space out there for this assignment. Let me stop sharing so I can see your reactions to me giving you homework. Those 5 problems, they'll be due before class on Thursday, and we will go through them in class. And then we'll start in chapter 3. I know it's not on the syllabus, although I did say that we would touch on chapter 3. I want to go through the ratio analysis just so that you're familiar with it. And I guess looking forward in time here, then I'm anticipating that probably next Tuesday we'll have our first exam. Okay, so and that the first exam would then be on chapters 1, 2, and 3. But we'll talk about that more on Thursday. Remember, Thursday's class is still going to be remote with every expectation that I will be back to in-person learning on next Tuesday, a week from today. So any questions? If not, then have a great day. We'll see you guys here on Zoom on Thursday.
Have a good day.
Have a good day.
You too.
Have a good day, Professor Gomolchak.
Thanks, guys. You have a good day too.